Welcome, everyone, to Advantaged and Alloy Partners podcast. I am Drew Beechler, a VP of Marketing here at Alloy, and your host of Advantaged. Alloy Partners is Venture Builder. We partner with leading organizations and entrepreneurs to co-create advantaged startups and venture studios that unlock growth and transformation. And on the podcast, we interview corporate innovators, founders, and investors all around venture building and startup corporate partnerships, corporate venture. We're telling the stories of how corporates and startups win together. And so today we have myself and a special guest, Nicolas Sauvage, founder and president of TDK Ventures. TDK Ventures is a technology-focused VC firm that spun out of TDK. They invest globally in early-stage startups that leverage fundamental material science to unlock attractive, sustainable futures for the world. And so I am thrilled to have you, Nicolas, with us here today. Thank you so much for joining us.
Thank you for having me.
Maybe let's start at the beginning. Tell me a little bit of your journey to TDK, what you were working on at TDK, and then how that turned into and inspired you to start TDK Ventures. Specifically, what experiences helped shape this vision and journey toward TDK Ventures?
And I hope it's inspiring for whoever is listening to know that there's no one journey into corporate venturing. So I came into TDK from an acquisition. So I was living in Taiwan, relocated to California to join a company called InventSense, which was a public company. I think within a year, we were getting acquired by TDK. And at that time, I moved from a role of sales to a role of ecosystem into InventSense. An ecosystem is basically being responsible for everything except the customers, which is the responsibility of sales. And when TDK acquired InventSense, I started to have a bigger scope, of course, for ecosystem. But I also took 6 weeks to go to a Stanford executive program. During that program, I had a class with Jesper Sorensen about exploitation and exploration. And the way that he explained it with a really compelling analogy was exploitation is your company trying to go to the peak of a mountain, and you have other competitors around you trying to also go to the peak. And you can define the peak as revenue, profit, customer delight, whatever it is that you want to define your peak. But that's exploitation. Become the best at what you do and make sure that you stay at the top. Exploration, on the other hand, when it comes to corporate venturing, is about this tiny helicopter flying to different peaks in a cloudy day where you can't really see far, and flying back with information about which peak is hostile or not valuable or too small, or coming back with, actually, that peak is amazing, it's fertile, this is where we can really build the next pillar for the company. And the small helicopter is because you don't need to make a $500 million acquisition to discover it's not a great space for the company to go. And so the $2 or $5 million that a CVC may do to invest in a startup and learn with the entrepreneurs who are building the future, whether it's the right place to go or not, is the exploration mission. And if you think about strategy, it's really about deciding where not to go. But when you decide to go, you want to go with confidence, with really good research, and with all the facts on your side. Even though it will still have a level of uncertainty, you reduce this. And so after that, I was like, I need to pitch that idea to TDK. So I explained why we should do corporate VC to TDK. I learned afterward that many people had tried to do that in the past. And as you can see, I was clearly the least obvious person to propose. I came from an acquisition. I was not even a year in the company that was being acquired. I was not Japanese. I don't speak Japanese. I was not in Tokyo in the TDK headquarters. So clearly I wasn't the obvious choice to pitch. But I think what worked really well is TDK's management is all about first principle thinking, very open to innovation. They had been disrupted in the past when they did the TDK cassette, and they had seen the disruption of streaming coming and so on. So they knew what was the challenge of not knowing what could kill you as a big corporation. And I think that exploration mission resonated really well with where TDK wanted to go with long-term strategy, exploration of the next pillar, but also understanding what could kill you and therefore understand how to address that.
We use similar but different terminology a lot of, at least our CEO does, around you want to be running fast, cheap, and weird experiments and this whole experimentation culture? And how do you find out what's going to disrupt you? What part do you want to play in shaping the future within that industry? And it doesn't take a $500 million bet to figure that out. It can take lots of smaller, cheaper, weird bets sometimes. And sometimes those are investment scenarios that have nothing to do with the core or that could be very tangential.
Yeah, I think the weird is interesting because I think weird is basically what's not yet obvious.
Yes.
And so it feels weird. It's not what people think is going to happen. But if you invest before it's obvious, this is where you're going to make your alpha. This is where you're going to learn about the future that's being built. And so I think that terminology you're using of fast, cheap, and weird makes sense to me because you want to make small bets to different futures. Hopefully, they should not be correlated futures. They should all be not obvious, so what you say as weird, and hope that some of them will really become successful.
Yeah, it's all about generating that alpha. This was in 2019 when TDK Ventures started, correct? So just before the pandemic. I think if I read correctly, you recently wrote your 50th check into a company. And so tell me a little bit of how it's going since then, how the organization has evolved over these first 50 investments as well.
Yeah, actually, we closed our investment number 50 on December 31st. So yeah, I think we are, in the next 2 weeks, we will get to number 52. But we have started in 2019 with the first fund. And maybe it's a good advice for your audience who are thinking about starting a corporate VC, which is start small but meaningful. And so the first fund we did was $50 million, 50. It was not meant to be a big fund. It was meant to prove that we can do our exploration mission well. We can prove that we can source really good entrepreneurs. We can, of course, invest in them because it's not just about wanting to invest. You have to have a good way of convincing the entrepreneurs that have a choice of investors to choose you. Make sure that you bring value to them, which means that in your design of corporate VC, you have to harness that superpower that can come from your mothership and bring it to bear with the entrepreneurs. And then, of course, prove that strategic value, prove that financial returns like a VC, which is under the power law type of outcome. So all of that was a design, and you wanted to prove in the first 2 years that we can build a portfolio that's diversified enough, that is valuable enough for learning and for bringing value. Fund 2 was started in 2021. At that point, we built confidence. We could see that we were doing well for the entrepreneurs. We were really adding value. We had good NPS score from them. We started to get more confident to lead rounds and to co-lead. So we start to learn the craft. So that at that point, the fund was $150 million. In 2023, we launched our first multi-LP fund, which was thematic and geographic. And that one was called Fund EX1. EX is for energy transformation. So think about the electrification, the decarbonization. And then last year in 2025, we launched our Fund 3. And Fund 3 is a single LP. And so the intent is to continue to have this tethering to the mothership with our single LP fund, Fund 1, Fund 2, Fund 3, where we have the ability to augment our mission with multi-LP funds like we have done for Fund EX1. Now, of course, we have to prove the model works. We have to prove that it is successful, both in terms of financial returns and strategic value. We don't see one or the other. It has to be both. And I can even make the argument it's highly correlated. But that's what we've been doing. And so now we had 500 million. We had 50 portfolio companies. We've had one IPO, I think 5 or 6 M&A now. We have 6 unicorns. And we invest always early stage. So think about seed or Series A. We've done some at inception. And once you include Series B, it's more than 95% of all our investments.
Can we talk a little more about the strategic decision to bring on an outside LP? I think that's really interesting. And I think how you're layering that into the strategy with very specific verticalized funds. How do you think about, how did that come about? How did you think about that strategy, pitching that back to corporate TDK as well? And How did you go about, these are the people who want to partner within this?
It's even better than that. It's not an outsider. It's one of the TDK companies that is quite independent, that is very sizable. They are about 40% of the TDK revenue, maybe more now. There's a market leader in batteries for consumer products. And so it was quite an obvious fit for us as we are trying multi-LP fund to have this LP to start bringing massive strategic value while we bring strategic learnings to them. And of
Yeah.
course, in spaces which they are very interested to learn, which was North America and Europe, in that electrification space. So think about that LP is super strategic. They want to know what could kill the battery that they are developing today. So they want to know what type of energy generation, energy storage could compromise the business of batteries they are doing today. So they are definitively in that exploration mission, which we could bring as a mission for Fund X1.
That's really interesting and unique, I think, just in the world of corporate venture, but also in how you think about marrying that strategic value with financial return, and it is really important.
So I'll come back to that point about correlation. I think, and I can make the point maybe simply with the extremes. I have 50 portfolio companies today. If they all go to zero, my financial return is zero. It would be very hard for me to argue strategic value. Okay, we learn where not to go, but that's really little. Let's assume now for a second that my 50 portfolio companies become all market leaders, all unicorns, all in a massive trajectory of success. My strategic value would be insane because we would have market leaders as partners, customers, suppliers to TDK and TDK companies. But we would be the best VC in the entire world if they were all fund returners like this, okay? So my point is the correlation between financial success of the startups means they become the winners, the market leaders, and that's exactly where you have maximum strategic learnings and strategic value, including from the engagement and synergies with the mothership. And so whenever someone asks me, are you strategic or financial? I like to be cheeky by saying we are pure financial, which of course shocked because they're like, oh, what do you mean? You don't care about strategy? I say, no, I only care about bringing real billions dollars annual revenue business to TDK, which you could argue is purely financial. And so one way that our CEO Saito-san explained it really is what we do as a corporate VC is pre-financial. It helps us to decide on our strategy and where to build and where not to build, which then leads to financial performance of TDK. And so that strategic value is pre-financial and that leads to financial.
Yeah. I think great example too, when you look at OpenAI and Microsoft or other corporates too that are in some of the large, specifically foundational model companies, massively huge financial wins for these companies, but also that is what's building the next stage for Microsoft of what's coming next for them has been that strategic partnership and investment into OpenAI.
But what's nice is it's valuable on both sides. So if you think about OpenAI would not be where it is without Microsoft and vice versa. And at some point they might diverge in terms of paths, but there's no doubt in my mind that Microsoft has learned a lot and is building amazing products and solutions thanks to what they learned with OpenAI and vice versa.
This is in the same vein, but I'd love to dig into a little bit more of one of your specific investments you've been more public around with Groq. I've read some of the posts that you've written about your investments and conviction around Groq, both more recently and like the original memo, which is around the original investment, which is really interesting. I think as well, you took a pretty big bet with Groq as well, conviction heavy bet. So tell me more about that company and the decision and what made that kind of a very conviction heavy bet for you and the rest of the TDK Ventures team.
And actually it's a conviction based, but not team conviction, because in this case, my team thought it was silly to have invested in Groq, so I can speak to that. But Groq was my third investment, and you mentioned it earlier. We started TDK Ventures just before COVID. And when COVID hit, it had two effects as far as we were concerned. The first one is all the VCs start to pause and focus on their portfolio companies. So they stop looking at investing. And it's not all of them, but many of them. And the best entrepreneurs like Jonathan Ross at Groq start to look at it, getting funding much earlier than they needed. And so during that period of, let's say, 3 to 6 months when it started, really, we had this amazing opportunity where we had the best entrepreneurs looking for funding and very few VCs looking to fund. And so even though we were only getting started, and I think we only had made 4 investments in 9 months, during the next 3 months during COVID, we made 4 more investments. So we really managed to make really good investment at that point. And Groq is one of them. But because it was COVID, it meant that everything was online. And even though we were like 20 minutes drive from each other, everything was on Zoom. And one of the things that I always want to do for our investments, and for my investment in particular, is to spend 1 hour CEO interview. I want to talk to the founder for at least 1 hour to really understand how they are thinking about it. And I do have an advantage. So we talk about advantage. I do have an advantage is that I'm an engineering by background and computing and software developer. So I really understand the space of computing. And so that was not where I was concerned about, because I could tell the architecture of Groq was so simple, so streamlined, so efficient. There was no way you could run inference faster for a given node than Groq. And Jonathan could convince me very quickly, but his team also convinced me. So what I wanted to understand was, how does Jonathan think? And what was truly amazing is for 1 hour, we covered, I want to say 60 topics, probably less, but we covered so many topics, from how do you define the core value of your company? How do you define the recruitment principle? How do you fire people? How do you think about fundraising? Many topics. And for all of them, he would answer from first principle. He would start by looking at, these are the facts, this is what I'm thinking about, and that's how I would act. And from everything from first principle. And I think I only learned it afterwards, but it makes total sense. You talk about university dropouts. He was a high school dropout, which means that he didn't have that shortcut that education can give you, which gave him that advantage, that superpower of thinking from first principle for everything. He would challenge everything until it becomes first principle. And that gave me such high confidence that there was no problem that would be thrown at Jonathan that he wouldn't be able to articulate from first principle and choose the right decision. And so I remember ending that CEO interview saying, yep, I'm in, I'm sure. And that's how I wrote my meeting notes. And I think in the meeting notes, I even said, I think I just made the next NVIDIA. And can't quite remember, but I could check. But what's interesting is in my investment committee proposal, 2 things which I went back actually. One is I said, this is the opportunity for us to invest to make our first investment in AI computing and our chance to invest in the next NVIDIA. So that was in our slide 4. And then one thing that we always do for our investments is we have scenarios for multiples. So we try to think about different scenarios, like the worst case scenario, it goes to 0. What's the probability for that? What is the base case that we should assume, and what could be the outcome in terms of exit? And what are the benchmarks to justify it? What is a better type of outcome, and what would be the multiples, because they can win more, in this case, more markets and more customers, maybe they go global. And then what is the very best case and what's the probability? And I just looked back and I actually had put my best case at $20 billion. And the justification is they become the next NVIDIA. So this is quite spooky when I read this, and you know about December 2025, it's not quite an acquisition, but they got the $20 billion deal with NVIDIA. And today I was watching the video of Jensen at GTC where he basically showed Groq being so central to their inference roadmap, super highly integrated with NVIDIA. And it's so obvious that $20 billion is such a cheap deal for NVIDIA. We're going to get 1,000 times return on that investment.
I love that story. You talked a little bit earlier about the life of the fund and across all these funds. It's so critical early in your journey. Like, how do you have early wins? This being one of your first 5 investments is is so critical to the success of the fund as a whole. It makes a huge difference. But what else has this taught you? How do founders think through first principles and how do you evaluate amazing founders? Seems to be one, but are there any other lessons that you've brought into other investments now based on what you've learned through the Groq investment?
First, I think that all the way until early 2024, no one would have said it's obvious they will succeed. Actually, I was the only one to believe in Groq in early 2024. Everyone in my team thought it was going to go to zero. And they were not wrong. By that time, they nearly died 3 times. Okay. So it was definitively not your obvious success. And this is where sometimes I smile because this sentence of overnight success take a decade, I think it's overnight success takes a decade and probably 4 or 5 times near death moments. I think my biggest learning from this experience is the real liftoff for Groq had nothing with technology. It was about business model and a shrewd acquisition. It was about moving away from trying to sell chipsets, and they'd done different pivots in terms of which market they would sell the chipset. And by the way, they had the best chipset for inference, bar none. It was so hard to sell chipset when you're a startup and you have to prove your supply chain and everything else. And they moved to selling tokens. That was a moment where Groq lifted off. They started selling to developers versus OEMs and people who need to buy chipsets. That was a moment where really everything changed. And it's so easy for deep tech VCs like us to think that technology is what makes a company successful. I think that sometimes it's just a business model, finding the new business model. And of course, ChatGPT and the LLM moment really helped. But where I want to give huge credits to Jonathan and the Groq team is they saw the LLM moment with Llama becoming open source. They jumped on it and they put all their weight, all the speed they could apply to that change. And they were really entrepreneurial. And that, I think, is what made them as successful as they've been since.
Business model innovations, distribution, I think in particular, are becoming more and more important moats than ever before. I think especially in today's AI world, which seems to be just changing every quarter. It feels like a whole different age, to be honest. I think even that is accelerating that even more, that it's the business model innovations and the distribution moats, basically, that are the defensible competitive advantages. And I am a software person too. So I think that is way more impactful in software. Do you see the same thing in deep tech and how AI is impacting deep tech in that sense too?
But I think, again, this is why I think we need to go back to the founder. I think you need a founder who's open-minded enough to change and to make that pivot. But it's not any founder. Jonathan was able to raise huge amount of money even before that aha moment, that perfect go-to-market with the tokens. So it's not like any founder. He was able to think from first principle. He was able to raise huge amount of money with increasing valuation. So there is something really special about him. But the learning that I'm taking away that's maybe not obvious is that Groq was not an obvious success until that go-to-market change and the selling to tokens. And when you look for founders, and if the founders is too stuck into the way of thinking about how they want to approach a business, they might miss on the big moment because they just want to stay with what they know. And so when you interview them, I think you really have to think about how convinced they are about their idea, but how open-minded they are to change it if they have compelling facts. And that's really a difficult combo because you want to invest in entrepreneurs that are so committed to their ideas. They want to change the world for the better because they have this inside, this superpower. And yet you want them to still be able to be open-minded to change something dramatically, like from selling chipset to selling tokens. This is a big change. And you bet the company on that change.
That's one of the underrated skills, I think, of an investor as well, is the people component. And how do you judge or grade founders, especially in the very limited, I think, data that you have on them in the time that you make investments, which I think is huge.
For anyone who has recruited at least 20 people, it's very humbling because you might think you're getting good at recruitment and then you make a big mistake. And I think when it comes to people, you're going to make many investments with many amazing founders. You think they are amazing at the time, and then you might realize not. And this is where I think pattern recognition in VCs really matter. And that's also where biases kicks in, and it could be bad if it's not about pattern recognition. And then you have to be careful even about pattern recognition, because then you won't go into the weird investment, the not obvious investment. It's very tough. It's one of the things which is not obvious about VC is that you have to challenge yourself. And that's why I think building a great team around you that will challenge you and that will challenge each other is a true superpower.
That was where I wanted to go next, actually, is tell me more around the team around you at TDK Ventures, how you structured the team, and I think specifically too, how your team is ingrained back into TDK corporate and how you make that very successful, both on the strategic side and providing value back to the company.
Actually, this weekend, it's interesting you ask. This weekend, I wrote how we recruit at TDK Ventures. It's been internal, but not externalized. And I think I will post tomorrow on LinkedIn. So I will send you the link. You can put it in your podcast notes. But I think we have iterated on our recruitment so that we can really recruit passionate, kind, smart, and very diverse team members. We've optimized our recruitment process and decision-making to have the best possible team to make decision-making for investments and betting on entrepreneurs, but having the kindness to work with entrepreneurs with real empathy. And so if I think about, part of your question is about how do we engage with entrepreneurs and the mothership, right?
I think particularly like that can sometimes be very different skill sets within like a person or a team. So I think from that lens is where I was going as well.
Yeah. If I was to use a technical term, I think that startups and big companies have an impedance match where they don't type the same language, they don't have the same pace, they don't see the risk the same way, their governance will be very different. And so you want to be able to be this translation service. You want to be this osmosis that's nearly effortless, but it takes actually a lot of efforts to make it happen. And this is where there's this concept we have at TDK Ventures we call equal win, which is really about valuable engagements between the startup and TDK companies, where it's very valuable on both sides so that it can be sustainable for decades, not just years. And most companies would talk about win-win, but as when you're a small startup and a very big corporation, it's typically a small win and a big win. And the challenge is, it may be fine for 1 or 2 years, but if you really have these startups that start to do really well and grow, they won't feel good about this. And at some point they will move. And so whoever had the big win end up with nothing. And so what we prefer to do is to right-side the engagement so that it's equal win from the start and it can really last for decades. And at the end, if you think about TDK, we are a tech firm that was born in 1935 as a university spin-off. We really understand entrepreneurship. We really respect entrepreneurship. We really respect their product and their IP. And so for us to build this right sizing of equal win really is the way we do it. And now if I go back to my team, we have an engagement team. We have 10 people in the engagement team whose job is to connect all the startup and portfolio companies that we meet and we believe could build this equal win with TDK. And I think it's about 65 different TDK teams. And this is where maybe a tip for the entrepreneurs who are listening to your podcast is, if you want to enter a big company, reach out to their CVC because they will know who to talk to most likely. And even if they don't invest, that may still be a really good help to know which business group or business units to engage with. And if it works, most CVCs actually really take it as a positive signal. Or if you can start engaging with part of their mothership, you're more likely to get the investment. And then it's up to you as an entrepreneur whether you want that investment or not. But to have a unit, a CVC unit that has mapped the internal mothership, where are the teams, what their roadmap, where it might and when it might intersect with a startup's roadmap, this is gold.
I think you shared this was on a GCV webinar, maybe, where the matrix of kind of tracking that within the portfolio too, of how many of our companies across the 65 business units are working with them. And it's so simple, but it is, you would be surprised to think at how many corporate venture teams don't do that or just are completely unattached to the mothership, and usually not by design or not by choice. It is, I think, sometimes because of where it rolls into the mothership or how the corporation sees it, or just the stage that that corporate venture team is in its life cycle and things. But I think it's surprising how often that doesn't happen. Actually, though, it seems like it should be a pretty simple and no-brainer opportunity.
So what you mentioned is what we call the engagement checkerboard, where you can see on one side all the portfolio companies, and it can be used for startups too, and all the internal teams inside TDK. And then the intersection shows whether there's an engagement or not, and the color indicates the level of engagement. Is it an evaluation? Is it a design in? Is that a design win? And we open sourced recently, actually, the engagement checkerboard. So if anyone in the audience wants to download it and use it for their own purpose, it's under the open source commons license, so you can do whatever you want with it. Maybe I'll send you the link as well so that you can share it with your audience. And while we're talking about open sourcing, we also open sourced our investment scorecard, which means that now every entrepreneur can have a sense of what are the type of investment criteria, the way we score investment opportunities across 7 pillars. But also, if you're a VC or CVC, feel free to use that investment scorecard to be inspired, delete what you don't like, add what you want, leverage what you like. But it's also under the Commons license, so you can do whatever you want with it. We think it's a very strong TDK goodness for both entrepreneurs and investors.
I'll include both those links. That'll be great. Tell me more about TDK goodness, what that means, how you all have built this kind of ethos into the company, and how you pay it back towards the startups you work with as well in that sense.
Yeah, so TDK goodness, the word goodness actually was Greg, one of our HR guy from InventSense, who was using that term a lot. And I just loved the term. And so I thought that I needed to use that term somehow when we talk about bringing value to entrepreneurs. And so what we call TDK goodness is basically when we bring value to a founder, to an entrepreneur, to a startup, but even to our TDK colleagues or to our investing partners. But it only goes into our database of TDK goodness when the recipient validates it's valuable to them. So it's not what we believe to be valuable. We need to have the recipient saying, wow, this was valuable. And that actually is such a mindset shift from thinking you bring value. And it's so easy for VCs and CVCs to think you bring value because you think you do. And then if you ask, you will hear from the entrepreneur, that introduction didn't help me. That introduction helped me. That project with your business units was terrible waste of time, but that one was very valuable. And so we always count this TDK goodness from the point of view of what the recipient tells us was valuable. At that point, he can go into our TDK goodness database.
You're totally right. Everyone wants to be a value-add investor. I think you mentioned this early on in the call as well, but just even taking an NPS score on your investments, I think is abnormal in some ways, but I think that's a great start. But I think this idea of evaluating, hey, we think we're giving all of this value back to portfolio companies, and oftentimes we don't stop to ask, what is the most valuable? Was this valuable? Did it pan out? And I think then making sure you're spending time on and investing in the things that do provide value, because sometimes we are investing lots of money, time, resources, people on things we think are providing value that at the end of the day aren't actually moving the needle, which is really important. And sometimes it's difficult to hear that even.
I wrote an article about how we do NPS methodology, which has a link to also, but it starts with, as a firm, and that's true for a VC firm, but it's true for any firm, you have to decide who is your customer. And when we think about VCs, you have two choices, and then you have a terrible choice. One choice is the entrepreneurs. They are your customer. The second choice is your limited partners. They are your customer. And the very bad choice is to say both are customers. And why is it a very bad choice is that if you say that both are, there will be times where your team will be having to choose between the two, and they will be inconsistent in their choice. You have to pick. And so the way we think about it at TDK Ventures is entrepreneurs first. They are the customer. They are the heroes of our journey. TDK and TDK companies are limited partners. They are the shareholders. We absolutely want to bring value to them, but the customers are the entrepreneurs, and that drives all our behaviors, and they're all consistent because we've made that very clear from the beginning.
Let's end with one kind of closing topic here. I'd love to talk about just the broader CVC ecosystem as a whole. I think you have a very unique point of view you can share. You recently took on the role of chair for the Global Corporate Venturing Leadership Society Advisory Board. GCV just recently released their annual World of Corporate Venturing research report, which had a ton of really interesting findings. Next week, which hopefully we'll publish this in the next couple of days, but next week is one of GCV's, I think it's the largest GCV conference, GCVI conference that they do every year. They do a handful across the globe. This one is in Monterey next week, where there'll be 800 corporate venture leaders there.
Including your colleagues?
Yeah, including us. Alloy will be there. Elliot will be speaking around with our friends at Elanco Animal Health around building an inside of a venture studio. So I think there's a lot going on right now. I think you have this really unique position and kind of viewpoint across a lot. But one of the biggest things that the research is showing and that we're seeing is just CVC and corporates are playing a larger and larger role in just venture funding and in the startup ecosystem as a whole. So maybe my question is, are you seeing and feeling that in the same way? What impact is that having in the broader ecosystem? And what do you think this means for corporate venture leaders and how they think about their role in the ecosystem and where their role should be in the future and growing in the ecosystem?
I think if you look at the last 10 years, corporate venturing has changed dramatically. I think we're at 10x the number of CVCs. We actually had the highest number of CVCs ever as tracked by GCV. The professionalization has absolutely improved. 10 years ago, you would easily argue that CVCs were on average a real negative. VCs didn't want to work with CVCs. You had a few exceptions, and Intel Capital has been one that has been doing well for a long time, Samsung Ventures, but most of them were really behaving badly. And that's what I would call CVC 1.0. I think we are moving to a highly professionalized corporate venturing ecosystem where CVCs start to work better and behave more like VCs while bringing a superpower, that strategic value from the mothership. And what's interesting about the fact that we are becoming so many CVCs, the highest ever, we are starting to make even bigger checks than ever. You talked about Microsoft and OpenAI earlier. You're going to see that more and more, and AI is definitely a place where corporates can really shine and bring not just capital, but real superpowers. And that to me is an analogy I'm going to talk about next week, which is I feel like we're moving to the point where entrepreneurs can get maximum value when they see VCs and CVC as a yin and the yang, which is you want VCs to really understand corporate VC and to take advantage of them at the same time as corporate VCs that behave like VCs and take advantage of their best practices. And when you have a cap table where you have really good VCs and really good CVCs, magic happens. And so my biggest takeaway is the last 10 years has been a really nice professionalization with some challenges along the way. And by the way, I think during COVID, CVCs really shined. They really showed that they can stay and continue to invest despite a very challenging time that was beyond the pandemic, but also supply chain challenges, geopolitics and politics. They've managed to continue to support their portfolio and continue to invest in really good founders. I think the next 10 years is really interesting. I think this is where corporate VC could really compound their value, but also partner even better with financial VCs. And I think that partnership will be a massive value add, system value add to entrepreneurs.
I agree. I think the next 10 years in corporate venture, I think in traditional venture as well, even the next 5 years, I think is going to fundamentally change a lot of what we think of as VC. I think a handful of, in my mind, a handful of things that I'm just keeping my eye on are the returns profile for VC and private equity as an asset class. I don't know if you follow Dan Primack and Axios, but he's been writing quite a bit about this the last couple of weeks of all of the comparing PE and VC as an asset class to the S&P 500. And yes, it's a power law, both in your distributions within inside a portfolio, but also like within VC as a portfolio, which I think is really interesting. But I think that's something very important for us to look at and think about. And then I think also the influx of capital too that you have from private investors potentially into when and how much and what it really looks like, I think will be very different. But if people started investing out of their 401k into private equity, I think will be really interesting. And I think that'll also, the influx of capital could completely change the game. And then the other thing that I've just been thinking a lot about too is the bifurcation within like the venture industry. I think right at a moment in time, you're seeing a ton between AI startups and non-AI startups, but also just within the traditional kind of investments, like early stage investments too, like down to the $30 billion check or whatever into OpenAI. The company's staying private much longer, but they
Yep.
are sucking up so much of the capital that looks like it's going into the venture capital kind of asset class, if you will. And so anyway, I think all of these compounding will mean just that venture looks very different in many ways in 5 years than
Yep.
what it does today. I think corporate venture is in a unique spot to, I think, take advantage of a lot of that, where I think there's some of those, I don't know if I would call them headwinds or tailwinds, but just trends and challenges in the industry that aren't going to affect corporate venture quite as much. The ones that are well positioned to take advantage of that as a corporate venture team, I think are going to be standouts in this next environment, in this next vintage of funds. To your point, the more that corporate venture can be a partner and tied with traditional venture is going to see amazing returns. We see that within our own portfolio as well. We tend to be very heavy on that side of like traditional venture and corporate venture because of the work we do. But that is where, yeah, the magic happens. I'm watching a lot of the similar things. I think next week will be great in Monterey to see so many venture leaders there. I think see so many, how they're evolving their own teams and strategies. Intel Capital, I think, is a great example of the spin in and spin out and back and forth. And what does it look like when you have
And the CEO was a very strong VC himself.
yeah. And it's just so interesting to see too, like just the change in strategy. And when you have a company that's so famously successful as an investor as well, what happens with that institution is really incredible and interesting. So we're looking forward to it. It's been a ton of fun to engage with that team and that community. Any parting words? I know you've given a lot of advice broadly across the last 40 minutes or so here, but any other parting words just for other corporate venture leaders out there, either starting and thinking about starting a new fund? Maybe let's start there, because I think that's so pivotal to your journey, was the creation and kind of growth of TDK Ventures, but specifically those that are thinking about starting a corporate venture team or in the early days of their journey. Any other kind of parting advice that you would give?
I think the biggest one is think about your why, validate your why with your mothership, secure good alignment and executive support for your why, make sure that your why will resonate with entrepreneurs. You will be able to deliver and harness the superpower of your mothership towards the companies you would invest. It all starts with a why. So maybe I will send you the link as well. I did a video back in 2021, I think, on YouTube about the 50 learnings that I had, or 50 tips about how to start a CVC. And one of the biggest is a why. Really make sure your why is clear and doesn't change, because you've got the right support for it. And if I think about the why that we have at TDK Ventures, it's really that exploration mission, and deliver on that exploration mission. And it doesn't change since I made the proposal to the board of directors of TDK. I think this is probably the most important thing, but one advantage, I think, for people who are starting today is that the ecosystem has matured so much. You start to have GCV. We're inviting at GCVI Kaufman Fellows, the CEO of NVCA, back to this yin and yang, making sure that we bring more value to the ecosystem. We are building more trainings. I have my own podcast, which is actually about practitioners of corporate venturing. It's called Corporate Venturing Insider. Anyone who wants to start today has so much more materials than when I started in 2019. There's so much more that's understood as best practices. GCVI next week, I think we'll have more than 800 people from CVCs. This is like the mecca of corporate venturing. We are going to have a GCV symposium in June in London, which is amazing for the teams in Europe to go and meet with other peers. So I think we're moving away from how do we survive as CVC to how do we perform and bring the value we were intended to bring as we started. So I'm extremely positive and optimistic about corporate venturing. I agree with everything you said. I think VCs are going to go through real transformations, which I think is good. And corporate venturing will continue to mature and bring more value. And I'm really hopeful for that yin and yang to really bring this amazing magic for our builders of the future.
I love that. That's so important. The why needs to resonate with not just the corporation, but also with the founders. I think is so important. You snuck that in, but I think it's so important that oftentimes you don't think about that. If our why as a corporate venture, our strategic why could have nothing to do with the founders and they could not rally behind that mission at all. But I think they need to be able to rally behind that vision and mission for you as a corporate venture team, which I think is important.
One thing is the why for TDK Ventures and many corporate VCs is exploration. But your why could be exploitation. It could be improving your current business. And if that is your why, and this is well aligned, and you build your superpower to bring value on an exploitation mission to entrepreneurs, and you communicate accordingly, it's really good too. So the point is not to pick the why of someone else. It has to be the why that makes sense for you and your mothership, and then you communicate it and you deliver it well to entrepreneurs. You do that well, you define that why, and you design the CVC accordingly, magic will happen.
It's so important. Thank you so much, Nicolas. This was an amazing conversation, but also just a ton of fun to spend the last hour with you talking about all these things. We will see you in Monterey, and thank you again for joining us.
Thank you, Drew. Thank you.